And we should be live. Just waiting to see if the screen is popping up. Oh,
okay,
there we go.
Sweet.
Awesome. All right, guys, thank you for joining us for this webinar about taxes for creators and makers, produced by AIR. And we're here with Kelly Sax. She's a certified public accountant, and she's from Montana. She specializes in small businesses and independent creatives. So we're super happy to have her on board. She's going to give you guys some tips and tricks of the trade for being an independent producer with your taxes.
Thank you very much.
But if you want to ask questions, we can type them into the chat box, and then we will have them just up from the YouTube stream. So we'll have Kelly introduce herself now and take it away.
Thank you. My name is Kelly Sax, and like she said, I live in Missoula, Montana, and this is where I do my business from. I work with people all across the country, though. Just a point, you can certainly, after the broadcast, if you have a question, you can certainly email me. I'm happy to talk to you for a few minutes about questions that you might have that might be more specific to your situation that you don't necessarily want to ask during this webinar. But anyway, go ahead and use my email address there if you have questions, or call me. So tax questions. Many of you maybe have been in the industry for a while. Maybe you're new to the industry. Maybe you're newly self-employed. But so I'm going to go over some questions that relate to most of you. So the first thing that you'll want to do when you get together your tax situation is you want to round up all your forms, obviously. So, and you're all familiar with the forms that you get in the mail every year about this time or within the last few months. This is a list of the forms, the primary forms that most of you will get. The biggest one for independents like yourselves will be the 1099s. So a 1099 is just a form that people that you work for will send to you, and it will show you, and it will also show the IRS how much they paid you. So the IRS, they say they do matching. They say that they match your tax return to the 1099. Whether that really happens or not, it would be a very large scale project for them to do that, but they do match to some degree. So any amounts that are shown on your 1099, you really need to report that, at least that amount on your tax return. That said, if you receive more income that's not reported on a 1099, a common mistake that independents will make is that they will think that they don't have to report that because they didn't receive a 1099, but that's not true. So any income that you receive, whether you get a 1099 or not, you need to report it on your tax return. The other forms that you need to get together are your W-2s. If you had a regular W-2 wage earning job, you should get together all of your receipts or a list of all of your expenses for any business-related purchases. The newer thing is, of course, your health insurance form. Some of you may have bought healthcare through healthcare.gov, or you may have health insurance through a spouse. There are different kinds of 1095s, but you should find a 1095. Your car registration receipts, and then if you made any interest or dividends on bank accounts or investment accounts, you should have those forms ready as well. They're the 1099 divs. Usually on your December bank statement, you'll be able to see that amount. If you own a house, if you have property taxes, you should get together your mortgage interest statement and the property taxes that you paid. And then, of course, when you file, everything almost exclusively anymore is direct deposit or direct pay. So if you are receiving a refund or if you're paying taxes, you should have your bank information ready. Also, if you made charitable contributions, those are always helpful or oftentimes helpful. And if you're taking your stuff to to a preparer or an accountant, you should have your prior year tax return available too. one thing that people always ask me is how long they should keep those things for, and you should probably keep those on hand for 7 years. I, of course, exaggerate the value of what I do, and so I think you should keep your tax returns forever, but 7 years is probably all the IRS wants you to keep them for. For those of you that are growing into your business and haven't quite set up a bookkeeping system yet, QuickBooks is great. There's a reason why it's the most popular financial software in the world, and it's just very good. QuickBooks Online is okay as well, but a lot of people are also using Mint for tracking expenses. So I know I'm giving you a lot of information, but take what you want from all of this. So the next question that comes up in your industry is, am I a hobby or am I a business? And it's a big question. Normally the IRS wants to see at some point, they want to see that you're making a profit. They don't want to see year after year after year of losses, because anytime there's a loss on your tax return, it's going to decrease your taxable income, obviously, and they don't necessarily want you to do that if it's just a hobby. So you need to know if you're, they need to know if you are a legitimate business or not. So what they look at is, do you run your business in a business-like manner? In other words, are you just a lot of, one thing that, an example that comes up a lot are people that raise horses, and sometimes, and I'm not sure exactly why this one is always an example, but they always look at that. Do you just have horses? Is this your hobby, or are you really running a business off your horses? So they look at, is it a business-like manner? Do you have a business plan? Are you keeping track of your expenses? Are you keeping track of your income? Is it your livelihood? In other words, is the money that you make off your hobby or your business, is it actually supporting you? Do you make changes in your business plan in order to have more success? Have you had success in the past? The biggest one that they look at is, do you have a profit motive? So and for most of us that are self-employed, like myself, I definitely have a profit motive. I wouldn't be doing this just for altruistic reasons, so or just for fun. I have a profit motive, and so these are the things that they look at. I think when it comes down to hard numbers, they look at, okay, have you made a profit in 2 or 3 of the last 5 years? So the first couple of years, you have a lot of startup costs, you have losses, that's pretty normal. After 2 or 3 years, it may be something that the IRS starts to pay attention to if you don't start showing a profit. So next slide. So here are some mistakes that artists can make. The number one mistake that I see is that, especially when you're new into your industry, you're newly self-employed, you forget that you actually have to pay quarterly tax payments. When you're a W-2 wage earner, of course, they just take all of your state and federal withholding directly out of your paycheck, and that's why your paycheck is always lower than what you're really making. And so when you're self-employed, it's essentially the same thing. You have to take out withholding for Social Security taxes, for Medicare, for state withholding, for federal withholding, and they want you to do that quarterly. So when you're new, it's easy to forget that. The next thing is, and I think this is the biggest hiccup when it comes to when I have new clients come in that are newly self-employed and I do their tax return. The shock for people comes when they realize they have to pay 2 kinds of taxes. When you're self-employed, you have to pay self-employment tax, and you also have to pay income tax. So everybody's used to paying income tax. When you're a W-2 wage earner, you just pay income tax on what you earned. But when you're self-employed, there's a new kind of tax, and it's just generally called self-employment tax. And the first question everybody asks is, well, why do we get taxed twice as much? And you don't actually. What self-employment tax is just Social Security and Medicare. So you just have to pay in yourself your employer and employee's portion of the Social Security and Medicare. So you actually aren't taxed twice. It just feels extra hard because your employer isn't taking that out for you. You have to have the discipline to do it yourself. So just expect that. Self-employment tax is approximately 15% of what you make. So if you bring in $1,000, you can expect automatically that 150 of that is going towards Social Security and Medicare, and that's your self-employment tax. So, and then another 25%-ish is going to go to income taxes. So I like to teach my newer clients that when you bring in a check for $1,000, it's really not $1,000. It's really closer to $600 or $700. So the next thing that people run into is they incorrectly deduct their home office expenses. Many of us work from home. I have a home office, but I also have an office downtown. So people wonder, well, can I do this? Is it really helpful? What can I deduct? And we'll go into that a little bit more, but it's important to do it correctly. And the next slide will go into that in detail. Another thing that's hard to track, and sometimes I wonder how people that aren't in the profession prepare their own tax return, and depreciation schedules is one of the reasons why it's difficult. If you're in an equipment-heavy industry where you have you buy a lot of purchases of computers or office supply or office equipment or vehicles or something along that line, you're going to have an extensive depreciation schedule. Even if it's not extensive, though, everybody will probably have one at some point. A newer thing, however, in the depreciation world is that if you buy, say, a computer for $2,400, if it's under $2,500, you don't have to depreciate it. So if you didn't buy anything over $2,500 per invoice this year, you can just code that as office supplies when you do your tax return, and you don't even have to worry about the depreciation schedule. So that's good news for a lot of us whose computers generally run $2,500 and less. Anyway, just something to put in the back of your mind. This last thing I like to talk about, because oftentimes people will come to me and they'll say, is this going to push me up into a new tax bracket? I made a bunch of money this year. I don't want to pay the tax rate in the higher tax bracket. And I just like to explain this to people because most people don't understand our marginal tax system in the United States. So basically, you've all heard, okay, I'm in the 10% bracket, I'm in the 25% bracket, I'm in the 28% bracket. And so what a lot of people think is the minute you go into the new bracket, all of your income is now taxed at 25%. But that's actually not true. Like, for example, if the cutoff is $30,000, the first $30,000 will still be taxed at the 10% bracket. And then all the additional income, then even if it's just $2, will be taxed at the next higher bracket. So tax brackets aren't that as big of a deal as some people like to make them. So just keep that in the back of your mind. It's not something you have to spend a lot of time trying to maneuver to get under a certain bracket or not. And the pro tip I have at the bottom is, if all this stuff is new to you, you can always file an extension. There isn't a penalty for extending until October 15th. It'll buy you extra time. So you can always file an extension, and they're super easy to do. If you owe money, that's the only tricky part, because your tax is still due on April 15th. This year it's April 18th, but your tax is still due. So if you don't do your tax return, you don't necessarily know how much you're going to owe. And if you do owe, then when you file late, you'll have to pay some interest and late payment interest and penalty on that. It isn't always very much, so I would still encourage you to file an extension if you're it's April 14th right now, if you're still a little confused about what you need to do. What kind of things can I deduct? In business, anything that's considered ordinary and necessary. So somebody told me early on, you know, if it looks like business, if it smells like business, it's business. And as a self-employed individual, you have to make that decision. Some people are much more aggressive than other people, and you have to figure out where your comfort level is and what you can deduct and what you cannot deduct. Sometimes it's a gray area. So, but if it's ordinary and necessary for your business, then you should deduct it, or at least ask your tax advisor about it, or do a little research yourself on it. Things like office supplies, professional memberships, travel to for meetings, travels to conferences, editing software, meals, business insurance, and so forth. Those things are all considered business expenses. Meals and entertainment. If you go out to dinner with a prospective client, you are talking about business for most of the time. That's considered a business deduction. If you bring food into your office to feed, say, your coworkers, that's considered more of an office supply because it's inside the office and it's necessary for work inside the office. So that one's a little bit different. You can also deduct your mileage. You can't deduct your mileage from home to work, but you can deduct any business driving that you do that's not a commute. A lot of us have home offices, so if you do work from home, that's and you drive, say, to the bank to take some money to the bank, or if you drive to a meeting, you're automatically already at work, so you don't really have a commute if you have a home office. So there are some good mileage apps out there that the minute you get in your car, it just starts working for you, and later you can go in and code it to business or personal, and they seem to work really well. It's important to have a mileage, some kind of mileage book where you do it manually or use a mileage app. If you were ever to be audited, if you didn't have one of those things, chances are they're just going to throw out all of your mileage deduction or cut it back to a very minimal amount. So although most people don't keep track of their mileage, you really should keep track of your mileage. You get 54 cents a share per mile, so it is a good deduction. People often ask me, should I deduct my car, the actual expense of buying a car, or should I do mileage? And for most people starting out, mileage method is most beneficial and as beneficial as deducting an entire car. So a thing that people that are new in business don't think about sometimes is the equipment that you bring into your new business. So, for example, if you just started earning self-employment income in 2016, say you made your first, say, $10,000. But you didn't actually buy a computer, you didn't actually buy a desk, it was your first year, so you were just using what you had. You can actually contribute that equipment to your business and consider it a deduction as well. You can't use your brand new price of the computer you bought, say, 2 years ago, but you can deduct the fair market value. So if on January 1st, 2016, your computer is worth $1,400 versus, say, $2,500 that you bought it for, use the $1,400, but you can use that as now business expense. So again, working from home, a lot of us do it. So how do you decide if you can deduct a home office or not? A home office is considered a home office if it's exclusive to your work. So the IRS says that if you have a room in your home that is used only for work, and it's also your principal place of business, meaning that you don't pay rent for outside office space, or you don't work for someone in their office space, then you can deduct your home office. So what you would need to, in order to deduct this, is you would need to measure the square footage of that room. And you'd also need to measure the square footage of your entire home. And so you would come up with a ratio of how much of your home is used for business versus personal use. Then you can deduct that percentage of a lot of your personal, that were formerly personal expenses. So you can deduct a percentage of your rent, a percentage of your power, sewer, water, trash, internet, recycling, all of those utilities you can deduct a percentage of. You can deduct a percentage of your home insurance or your renter's insurance, mortgage interest, all of that stuff. So you think that it might come up to be a really, really big number. And for some people that live in a small home, it does. For other people, it's not that big of a number. If that's all too confusing for you, a few years ago, they made a new rule that you can just measure your office space. And as long as it's an exclusive office, that's your principal place of business, you can deduct $5 a square foot. So that makes it really easy. So if you have a 200 square foot office, multiply it by 5, deduct $1,000. So, and there is a special form that you use to report that. But I think when you're thinking of taxes that are, if you have 15% self-employment tax, and then you have another 25% of income tax for a home office, you're saving, $400 in taxes. So I think it's worth it. One last thing to note is if you do repairs on your home, you can also deduct a percentage of that at the end of the year. So even if it's repairs on the total home and not specifically on your home office. People will ask the question, how do I file? Can I file this for free? And this isn't always so straightforward. You can find online apps for free. A lot of people use TurboTax and they just pay for it. However much the filing fee is, it's $75 or $125, whatever it is. I'm not sure exactly, but there are free filing apps. So if you make under a certain amount, so if you go to free file at irs.gov, there's a free filing option there. If you make over their specified amount, you can also use the fillable forms. I haven't actually used these forms myself because I obviously am in the business and so I don't need to. The question is, do you want to do this? And I ask people, how valuable is your time? I imagine that a professional can do your tax return for you in probably 1/8 of the time that it will take for you to do it. So I ask people to just value their time and the frustration and also the certainty of, did I file my taxes right? That's a question too that I don't necessarily want hanging over my head. I also don't necessarily, I think taxes are complicated and I think it's difficult to file your own taxes. I like to tell people that oftentimes there will be savings when you use a professional, be it a smaller preparer or a bigger firm. They'll catch things that you don't know about. So just something to remember that there oftentimes, if you spend $300 to have your tax return prepared, you'll also have savings of $300. That isn't always the case, but it is something to consider. And I'm not just saying that just to, get business for my colleagues. It really seems to be the truth. Also, there is when people use TurboTax, I'll see returns come in from prior years that it's definitely a junk in, junk out situation. So if you think you can just punch in all of your numbers and then it's going to pop out that perfect return, that isn't always the case. If your tax return is pretty simple, it does work out that way often, but sometimes it won't. So just keep in mind that you should review your return afterwards, and just, even if you're not a seasoned tax preparer, you can look at your return and say, okay, does this make sense? does this final product that I'm going to send into the IRS, does this make sense? And just do a once over of what it's popped out for you to file. So those are the main points that that I wanted to talk about today, and I'm certainly happy to follow up on specifics either now or later. So thank you.
Thank you, Kelly. That was great. I would like to say, if you guys do have questions, you can either, if you have a YouTube channel, you can write directly into the group chat on the right side of the page, but you can also tweet us at airmedia, or you can email tran, T-R-A-N, @airmedia.org. And of course, you can also email Kelly directly. Her email is on the front, the first slide of this. So I actually do have some questions in the meantime if we're waiting for people. So I might just take it away if that's all right, Kelly.
That's great.
Cool. So we're wondering, is it true that I don't need to declare if I get paid under $600 for a gig?
That actually is not true, and it's a common question that I get. You won't necessarily be issued a 1099 because of it, because people that you work for are not required to issue you a 1099 if it's under $600, but that doesn't mean you don't have to declare it.
Gotcha. That makes sense. What about, are there certain tax laws that apply if you live abroad and you're completing work for, a company that's based in the US, but you actually are living in a foreign country?
There are, yes. If you're living in a foreign country and you're paying some kind of taxes there, you won't get double taxed. So there is a foreign tax exclusion. So when you file your United States federal tax return, you can deduct, I don't know the exact number off the top of my head, but it's roughly around $100,000 will be not taxed in the United States if it's been made in another country.
Gotcha. That makes sense. A few more questions coming in. So what would you do when you contract out work as a freelancer? So you're not completing it yourself, but you're actually asking for other people's input in their work. How would you complete that on your taxes?
That's a good question. So it goes, there's two parts to that answer. One, before you even do your taxes, you'll have to decide if you need to issue that person a 1099, because you then would be responsible for that. So if they made over $600 and they provided services to you as opposed to products, then you are required to issue them a 1099. So that's the first part of that. Whether you do it or whether you don't do it, legally you're supposed to do it, but even if you didn't do it, you can still deduct it on your tax return. So there's a line, I believe it's called outside services. You could consider it that, or you could call it subcontracted services. But if you pay someone $10,000, then you get to deduct $10,000.
Mm-hmm. Actually, regarding the $600 gig question that's sort of in the midst of this, would you say it's safe to say that you should always declare when you're getting paid, no matter what, if you have that $600 threshold?
Yeah. Many people will just rely on their 1099s, and because 1099s, the rules aren't, I wouldn't say they're common knowledge to everybody. So not everybody is going to issue a 1099, whether it's for $200 or whether it's for $3,000. So I recommend to people to just keep track during the year of any income that you receive. So if you receive 10 checks for $100 each, you have to report that $1,000 of income.
Okay, great. This has been super helpful. We have a few more questions, if you don't mind. We're like all scrambling to finish our taxes and want to make sure we're doing them right.
Yeah.
So some people are wondering, if you have, your personal business, but you also have just your regular tax form, would there be any sense in filing twice, once for your just personal life and once for your own business?
Probably not for most people. When you're a few years down the road, if you go into partnership with another person, you would file separately. Or if you were to incorporate, if you were making enough money, say over $50,000 a year, you might consider incorporating. But no, in fact, you wouldn't be able to file separately if you're in the situation that I think you're explaining. You have to file it on your personal return, and it's called a Schedule C. That's your business schedule.
Okay, yeah, I think that's a common misconception. So that's great to know that for the sort of ordinary independent producer like we are, we wouldn't have to do it doubly.
Right, exactly.
Cool. Also on the expenses and the sort of deductions that you can take, some of our members are curious about how it's possible to write off certain expenses like cable. For example, if you're watching cable or seeing a certain story on TV for story research, would you be able to deduct that and things like rent and electricity? How would you suggest keeping track of all these expenses and how much to actually deduct depending on what you've been using for work purposes?
Yeah, that's a good question. If you were to buy, say, a standalone product to watch something on cable, and it was specific to your work always, you could deduct 100% of that cost. If you just had cable in your house, for example, and say you spent $1,200 a year on cable, it would go into one of your home office expenses. So it would go on the home office form along with power bill, water bill, internet bill, cable bill, and then you would take a percentage of that based on the size of your home office. A follow-up to that is cell phone costs. People will often ask about their cell phone costs, and they'll say, well, does that go on my home office? And I would not recommend putting that on your home office. What I would recommend is figuring out what percentage of your phone is used for business. And say you decide that 80% of your usage of your phone is business for business purposes, you can deduct 80% of your phone bill as a business expense.
Right. So it's similar to that question of how much mileage you're driving outside of your commute. You're actually driving for work purposes. So you'd want to calculate that similarly. Is that right?
Yeah, exactly.
Great. It looks like we have one last question, and then we'll wait around for a few seconds just to see if anyone has some late breaking questions for you. But is there any or even a best way to set up your business if you're receiving a grant? I know a lot of our producers are receiving fellowships and grants and are wondering if those are taxable, and if so, how is the best way to navigate that?
Yeah, if you receive a grant, that is still considered taxable income to you. So you need to report it just like you would any other kind of income.
Okay, great. So it is taxable and there's not a separate sort of form to complete that.
Right.
Okay. Perfect. Well, it looks like we don't have any other questions. Let's just hang out for 1 second to see if any late breaking news comes in.
Okay.
Oh, we've got one more. So what about things regarding student loans? Do you have any tips on how you would file and how you would manage your taxes if you still have your student loans that you haven't paid yet?
Yeah, it's a pretty easy one. So basically, if your income level is below a certain threshold, like $100,000 maybe, and I don't remember the threshold exactly right now, but you can deduct your student loan interest that you've paid, and you just deduct it on page 1 of your tax return. So up to $2,500 you can deduct. You can also deduct or get a credit actually for tuition that you paid. So if you do take classes, even if you're not still a college student, if you're taking professional education classes through a university, you can also get an education credit for that. If you don't know how much you paid in student loan interest, I would recommend logging on to your student loan website, and usually you can just download the tax form for that.
Great. Well, I think that's all we have in terms of questions. So I just wanted to say thank you again, Kelly Sax, on behalf of AIR. And we would love to sort of keep the conversation going. So if you want to talk directly with Kelly, her email is kellysax@saxcpa.net. So that's saxcpa.net. If you have any other questions too, you can tweet us at Twitter on AIR Media, or send us an email, tran@airmedia.org. But wanted to say thanks again, Kelly, for being with us. We really appreciate it so close to Tax Day.
Okay, thank you very much for having me.
Thank you. Bye-bye.
Bye-bye.